Welcome back, everyone. Today, we're diving deep into the absolutely wild cross-currents driving the gold market as of July 2026. Look, it is quite literally a battleground out there right now. So whether you've been trading for decades or you're just a massive nerd for market mechanics like us, this explainer is going to give you the complete, top-down view of the current chaos. Let's decode what's actually happening behind the scenes.
Here is our roadmap for today. 1. The battle for $4,000. 2. Inside the COT report. 3. The bearish continuation thesis. 4. The bullish breakout thesis. 5. 6 essential trading questions. And 6. Master your trading mindset.
Section 1. The battle for $4,000. The critical price zone. All right, let's zoom in on this intense tug-of-war. Everything in the gold market right now revolves around this one massive psychological support level, $4,000. Gold is desperately fighting to hold this floor. I mean, despite some truly relentless selling pressure, the bears just can't seem to force a decisive breakdown. It's this incredibly stubborn demand zone where buyers just keep stepping in. But, to really grasp why this particular battle is so fierce, we've got to follow the money.
Section 2. Inside the COT report. Tracking institutional money.
So if we really want to understand this battle for $4,000, we have to look at the Commitments of Traders report from mid-July. The contrast here is just stark. On one hand, you have the commercials. These are your market makers, the smart money, and they are holding a massive net short position of minus 214,788 contracts. But then on the exact opposite side, leveraged funds, which are mostly your speculators, are heavily long at positive 186,682 contracts. It is a literal showdown. Institutional hedging going head-to-head with speculative buying.
Section 3. The bearish continuation thesis. Sellers in control.
So, how exactly does this build the bearish case? Well, multiple analysts have noted that gold is currently locked in a descending channel. On the technical side, there's this really stubborn descending trendline resistance that just keeps slapping the price back down every single time it tries to rally. Then, fundamentally, you've got a strong US dollar and some pretty hawkish rhetoric coming out of the Federal Reserve. And hey, as the old saying goes, don't fight the Fed, unless you really enjoy the pain. Capital is highly cautious right now, which makes a technical sell-on rally approach super attractive to the bears.
Section 4. The bullish breakout thesis. Buyers building momentum.
But hang on. Remember that $4,000 line in the sand? There are some incredibly powerful forces defending it. Yes, we have those bearish drivers, the strong dollar and the hawkish Fed, acting like an anchor on the market. But look at the bullish counterweights here. We've got softer than expected CPI and PPI inflation data, which historically gives gold a nice tailwind. Plus, you have geopolitical tensions in the Strait of Hormuz acting as this massive wildcard, driving a lot of safe haven volatility. So the market is actively weighing these neutral, softer inflation reports right alongside some very high-stakes global drama.
Now, to cut through all of this fundamental noise, a lot of technical traders are relying heavily on Smart Money Concepts, or SMC. Instead of just guessing based on retail momentum, it's all about hunting down where the really big players, like those commercials we saw in the COT report, are hiding their institutional order flow and their liquidity pools. And that leads us right to the classic liquidity sweep. What we're seeing is the price briefly dropping below that $4,000 floor, specifically to trigger retail stop losses. You know how this goes. That sudden rush of panic sell orders creates the exact liquidity that institutional buyers need to quietly accumulate massive long positions, all without tipping their hand too early. So for the bulls, these recent dips below $4,000, they aren't breakdowns at all. They're just institutions sweeping liquidity before a potential launch higher. Once that sweep actually triggers, the professionals just sit on their hands. They wait for a retest of order blocks. They are actively looking for those specific footprint zones where market makers have previously accumulated large buy or sell positions. Locating and trusting these blocks is exactly how the pros find high probability entries in all this volatility. They let the market prove its structure first before they ever jump in.
Section 5. 6 essential trading questions. The David Perk framework.
Which brings us perfectly to execution. Look, a beautiful chart means absolutely nothing if you cannot answer these 6 questions before risking a single dollar of your capital. Number 1, why are you watching this setup? 2, what specifically triggers your entry? 3, what proves you mathematically wrong? 4, is the risk to reward actually acceptable? 5, how will you manage the live position? And 6, how are you going to evaluate the trade afterward?
If you skip these, you aren't really trading, guys. You're just gambling on movement.
Let's actually pause for a second and really take in this quote. Discipline often means never opening the position at all. Skipping unconfirmed setups is the ultimate hallmark of a professional trader. If the market doesn't trigger your specific rules, sitting on your hands is exactly what you are supposed to be doing.
And that brings up a really crucial point regarding invalidation. My analysis stops making sense if price reaches this level. Way too many traders place a stop loss based on some arbitrary emotional pain point, basically just guessing how much money they're willing to lose that day. Professionals don't do that. They place their stop loss at the exact price level where their entire trading thesis is structurally proven wrong.
Section 6. Master your trading mindset, the operator behind the strategy.
Navigating a volatile battleground like this $4,000 gold level requires incredible psychological fortitude. You can learn a strategy in a few weeks, but self-awareness, that takes years. Look at these behavioral rules. Match your trading session to your actual life schedule. Please don't try to trade the London Open if you're totally exhausted. Decision-making runs on a limited tank, so only trade when your brain is fully rested. Match your trading style to your nervous system, and always remember, structure and rules beat willpower every single time. Willpower absolutely evaporates under pressure, but a strict daily loss limit, that'll actually save your account.
You versus you is the real game. I can't emphasize this enough. The market is not your opponent. The market is completely 100% neutral. The real challenge, the actual game you are playing, is managing your own emotional reactions to volatility. It is all about how you respond when a setup completely fails or when a massive green candle tempts you to totally abandon your rules. As we've been discussing, doing nothing is often a trading decision. Preserving your capital by staying flat during messy, unconfirmed market conditions is not a weakness. It's a highly profitable, highly active choice. Every bad trade you avoid is money staying right in your own pocket. All right, as we wrap up this explainer on the complex cross-currents of gold, I really want to leave you with this provocative thought. The next time you open your charts, don't ask yourself what you can trade today. Ask yourself, which of these ideas actually deserves my money? Demand confirmation, demand structure. Thank you so much for joining me on this deep dive. Until next time, stay focused and trade smart.